Allocation to exit, managing risk and reward in the juniors. So start off with an agenda, a few thoughts on gold and copper. Then I want to get into portfolio allocation and management, a topic that I've gotten a lot of questions on since I presented on it last. And then closing some words on my YouTube series Field Notes and my newsletter. So gold, I was recently in Argentina doing a site visit. And at the breakfast table, we were sort of talking about the markets, and one of the guys at the table asked, he said, that the move in gold has been parabolic. This is kind of synonymous with tops in markets. Are we at a top? And I thought it was an interesting perspective because, quite honestly, I guess with the price action that I've seen, I never really thought of gold being at a top. It's so different from the other commodities. But it's a good question, and it's something that I think everybody should sort of contemplate. So my answer is no, I don't think we're at a top. I think for all the reasons why, or you've heard probably a list of people talk about today, this sort of monetary reset, this move away from the USD as the world reserve currency, these sorts of reasons, I think, are reasons why it's moved like this and probably why it'll most likely continue, I think at least going higher. But you never know. There's what I've seen from on my side of things, an increase in questions, a lot of newbie investors to the sector. If you're bullish on a metal, I highly suggest you buy the metal first. And in particular, in gold's case, where I believe it is real money and it should be the sort of the cornerstone of what you start with before you start getting into the equities, which of course is where I think the big opportunity is. But metal price is just one reason why you can lose money with the equities. So it's just something to keep into perspective. So seeking alpha, we're all trying to make money in this sector. Using GDX and GDXJ, I think, is a good comparison. It's also a way for you to gauge the opportunity in the market. I've used both these slides before, but I want to reiterate it. The last high in 2011, you can see on both charts, you can see at $1,900 gold where that opportunity was and where that valuation went in both these indexes. You can see where we are today, and the proposed delta is what I'm saying is the opportunity. But we're in fact at $3,300 gold, and so I would suggest that the delta is even higher. But we'll see. The other point I think is you want to compare how you're doing as an investor to these indexes. If you can't outperform the index, you're probably better to buy the index. And Warren Buffett would support me on that. In fact, he would say that in generally speaking. But GDXJ and GDX around 38, 39% year to date. I take this opportunity to also promote my newsletter. Looking at the performance last year, average weighted return over 150%, and year to date we're up just over 90%, which is phenomenal performance. But it shows the power of picking right. Copper has been, I would say, somewhat of a disappointment in terms of reality versus narrative. And I'll be the first to say that I've talked a couple times and presented this chart and said, this is probably the year for copper. And it quite hasn't been. That's the reality of it. And it shows why I say things like, if you're bullish on the metal, buy the metal. These things are so hard to predict. And I've never met anybody in my career that can do that consistently, pick when metal prices are going to move up or move down. The narrative surrounding copper obviously is linked to net zero, this whole electrification of humanity. And what we've seen over the years, you've seen the copper price come out of the COVID bottom, but really we've touched $5 now or a pound, but we've never really been able to stick there. It's always come right back. Complexity in the market, but I think it's also a sign of this whole move towards electrification is going to take longer than the 20 years that politicians will tell you. And I've never quite believed that those goals were going to be attainable. But I do think that humanity is headed in that direction. And ultimately, we're going to need more copper. It's pretty much that baseline metal that if you're electrifying or you're increasing your standard of living across the world, it's that baseline metal that essentially does it, in my view. And I think in terms of where we need to be in pricing, you're probably going to have to be north of $6 per pound sustained to really incentivize production. When you look at those development projects that are sort of on the docket or those top 10 in the world, really you need that £6 per pound copper to really make them buildable. So I brought up a number of points that support why copper is going to go higher. And in January 2024, I thought, especially with copper inventories where they were, I thought 2024 was going to look pretty good. As I said, it didn't necessarily turn out that way. But what's been different this year is we do look like we're on a downtrend on inventories if you look at the far right hand of the chart. But I think if you also started looking or reading about what's happening in the smelter market, I think that gives you more indication of what is the reality of the market right now. Smelter treatment and refinement charges have gone down drastically, if not zero, which tells you that smelters are hungry for this copper concentrate. I think also when you look at the extra supply, mainly in China, that's going to come online in this year and next year, it also shows you that market becomes that much more competitive, and I think opens the door for higher copper prices as a derivative of that. Also interesting, I would call the move in the copper price, well, again, it wasn't sustained up over $5 a pound, but it was sort of stealth-like, how there weren't many people talking about it as it kind of moved through the $4 per pound range and eclipsed $5 a pound. And this is during tariff talks, which again, I think is kind of a glimpse on what's kind of happening in the copper market, what could happen, I guess, on the positive side, depending on how you look at it, for a copper price that has been so comfortable staying in the $4 range for so long. And I look at that as a general positive. Again, I think if you're going to invest in the copper market, you want to find stories that don't necessarily depend on you being right about the copper price. You want to pick companies with catalysts that are outside of the copper price and attention being grabbed to the sector just based on that. And this last point is, I think, one that you can leverage despite wherever the copper price is going. And it's related to water. So as I said, I was in Argentina. I was in the high Andes, above 4,000 meters. Invariably, the conversation went to water and the situation. It's particularly, they were talking about Jose Maria and Filo and how the company, and there was rumors that they were going to build a pipeline across Argentina and bring the water there. For those that don't know, there is a water issue with those two massive projects. And for them to become mines, they're going to have to sort this out. And so to me, I think considering the amount of volume that they need, it's actually quite elementary that you're not going to build a pipeline across Argentina. You have to go to the closer coast, and that would be across Chile. And this is where I think the opportunity is. Hot Chile. Now, I don't think this is a new story for anybody in this room. You've probably heard this scenario before, but I think today is the opportunity considering where their share price is at. Their market cap around 60 million. They own or have been granted one of two permits given for water extraction or maritime concession in the last 13 years. If you look at the image from their slide deck, you can see that Jose Maria, Filo, NGX, ATEX, all these massive, great companies probably require accessing water through Costa Fuego or through Hot Chile's maritime concession, which is a water rights company called Huasco, which they own 80% of. Now, I can't tie an exact value to it, but I'll just highlight that you have a 1 billion ton project in Costa Fuego that has a PFS that was just released last month, and it's selling for a $60 million market cap. And I would say that, the drop in share price could be from a number of reasons, but looking at their story, looking at the water rights as an X factor, to me, the gap closes on this relatively quick. And to me, it doesn't even matter where the copper price goes. The water rights is a story that has to happen regardless. When is definitely a question, but it goes down another path. The other X factor I see is they're drilling at La Verde. La Verde is a consolidated project that took them, I think, 5 years to consolidate these claims around the La Verde project. I believe it's a porphyry cluster. You look at the results that they've had to date. You can sort of guesstimate what tonnage they might have, but the fact is it's higher graded than what's at Costa Fuego. If in a feasibility study they put these things together, I think it shows the CapEx, which is mainly a reflection of the block caving underground earlier in the mine life. If you added these tons from La Verde, you could push that back, which would be very good for NPV. And so again, $60 million market cap, and they've got a lot of stuff going for them. So portfolio allocation, again, a topic I've talked about, but I've received a ton of questions regarding, so I thought I'd go into a little more detail and then give you an example about how I do it. So the first part is to start at the high level, and this starts with you. You want to ask yourself a couple questions, and you have to be honest with yourself. First is your risk profile. I think, unfortunately, people don't understand how much they don't like losing money until they lose it. And this is just a fact, and I can attest to it. I had to go through that myself. And that really adjusts because exploration is so sexy, yet it has the highest amount of risk. And you really have to understand from a knowledge point of view what you're doing. Whereas if you look at the other end of the spectrum, the producers, the royalty companies, it does seem kind of boring, but I would say you're more often than not looking mostly at balance sheet analysis versus understanding what these different geological models are and what the potential is for your exploration company you're invested in. I do think you need a little bit of both, but there's different ways you can do that. But be honest with yourself in terms of your knowledge level, your risk profile, and then where you are in the market cycle. Position weighting, I would say the performance you saw last year, over an average weighted return over 150%. And to me, that was solely they were good picks, but it was also how I weighted those each individual position in relation to my confidence level in that certain company. But these are the questions that I ask, and it's quite simple. You take out a piece of paper, you can use this presentation, and just answer these questions. So, company risk profile. So you're at the company level. Political risk, geological potential, anything else, the people in the project. You can do a little summary of what that looks like. The metal outlook, precious metals. I think it looks tremendously good. If it's copper focused, maybe you're not quite as bullish, but I would say that's also what the contrarian bet might be. Is there a financing risk in the next 6 months? If you're going to tranche buy or you're going to take steps, little pieces of the company or share positions as you go along, if there's a financing coming up, sometimes this can stagnate the stock or you can be some weakness and maybe you can plan to take a tranche at that point. Or if you're able to, you participate in the financing. Liquidity, most of these companies are illiquid, so it doesn't always matter in terms of, you don't usually get blessed with high liquidity, but sometimes you do. The point is that you think about it. Timeline to profit. When you write out that list of catalysts, the reasons why you think the market's going to pay attention and give them recognition, write these catalysts out. How long is it going to take? And you can also plan or try to plan your buying or your selling, because selling is just as important as buying, yet it's often the point where investors make the most mistakes. They think this thing is going to the moon, and especially if they've written something down, I would say if they make the mistake, they get too blue sky and they think, oh, this thing's going to continue going. I know where the metal price is headed, and you just follow the roller coaster right back down, and you're what they call a bag holder, which is unfortunate. And then last is a price target. So this is understanding the valuation. This is understanding how the catalysts are going to add value to the company. And of course, again, trying to pick out when those catalysts are going to come to fruition and when you hopefully are extracting profit. Position weighting. So this is just for your perspective. And this is something definitely give some more thought to. So let's say you have a $20,000 portfolio. $2,000 at 10% allocation in a company that has 100% upside versus $400 or 2% allocation in a company that has 500% upside. Two very different investments, but they can both pay you or potentially pay you $2,000 in profit. And to me, the question becomes which is more probable? And this is something that each investor has to understand and try to guess. I can say for me, from my experience, and I have my own money, the primary way I make money in the junior resource sector is through my investments. Allocating more to the positions that I'm more confident in has paid off in dividends, and it continues to do. And that's why the portfolio is up another 90% this year, because the good decisions we made in the year previous have sort of continued. And that catalyst structure is in place, and that's why it's moved up. And I'll buy at both ends. It's not just planning tranches out and only buying if it's weak. It's buying when you're getting more confident about it. When catalysts happen, sometimes the value proposition or the risk to reward is better when the share price goes up and you've seen a drill result or you've seen something happen that you thought was going to add value. And those can be times to add. I think a great example is with my presenting company, Thesis Gold. We took them in the newsletter last summer, so I'll take you through again the high level. The risk profile I wrote is medium. Their underlying value is linked to what they already have, which is 5 million ounces of gold equivalent, with big upside exploration on their ranch portion of the project. Metal outlook, I think, is excellent, very good, however you want to look at it. Like as I said, I think the gold prices or precious metal prices are headed up, or at least stay where they are. And so this is tremendous to their underlying value. Liquidity, it was low at first when we took the position, but with the good news and of course the market getting a little bit better, liquidity has improved drastically. So it's much easier to go in and out of the position if you want. Timeline, the way I view like a company like Thesis Gold, and this is kind of the contradiction that I see in the Lassonde curve. Most developers in the Lassonde curve you see are on the down portion, or the portion where the market doesn't care. And I would say outside of bull markets, that's mostly true. But in a bull market, where I've made the most money is investing in developers, especially developers that are discounted to the market, have the exploration upside, have this list of catalysts that can really push it forward. And so to me, that's where I've made the most money. And I think that's obviously going to happen again here. My original investment, I wrote, and again, this is something you as an investor have to kind of come up with yourself, but I wrote a 70% confidence level. I did a DCF, I did the due diligence, I got to know Ewan and the rest of the management team. I was about 70% confident I sort of knew how this was going to play out. Then we got the updated PEA, which came in September. So we took the position in June, came in September, and I linked that to my DCF that I'd done, my modeling. And there was really good correlation in terms of the assumptions I had made in terms of where that deposit was going, which confirms to me that I have a good idea of how these catalysts might add value. And then lastly, at that time, I knew the financing risk was high. They were going to be releasing the updated PEA, and they were finishing drilling off at Ranch. And I knew to complete a PFS this year, they were going to have to raise more money. So I incorporated that into my DCF or my valuation to make sure that I take that into account in terms of the price per share. So we initiated the position. I wanted to take a 10% position. I decided to take 5% off the hop. That was on June 14th at 69 cents per share. I wanted to take 2 or 3 more tranches to get to that 10%. Of course, you never know how the market's going to react. And if you go back to last summer, I still think there was a lot of doubt in terms of where the gold market was. The initial price target was $1.96 per share. And these are the catalysts I had written out. And you can see they've hit 4 of the 6. And those other 2 have just been put in place for this year. And this is the price chart, shows the initial position. The updated PEA comes out. The market likes it. Not only that, but if you recall, the market really took off in that September-October range. And then, of course, Trump got elected and it precipitously fell. And that gave us opportunity, though. I wasn't sure. I honestly, when it went up in October, I thought, this is probably gone. I'm probably not going to get that extra 5% at a lower price. And I was starting to go through scenarios on a higher price. And then I view it as a blessing. It goes down in price. I was that much more confident in the buy. We did 2 more tranches in the 50s. And I moved it to number 1 in the rankings. That's another thing I do in the portfolio is rank all the companies that are a part of the portfolio. And obviously the best or the best risk reward go to the top. And the share price took off. And then Centerra took a 9.9% position at $1.03. And again, that came off after the announcement, which again, it's a crazy market, but that marked opportunity. So managing the position moving forward, the catalyst, exploration drilling, you've got both continued epithermal drilling, but maybe the most exciting, especially in the Toodoggone, is going after the porphyry. For those that don't know, A-Mark and Freeport made this great discovery just south of Thesis's ground. These porphyry systems, or this system in particular, looks, considering the endowment they already have on Lawyers Ranch, I would say whatever porphyry fed that has the potential to be very rich itself. And I think we're going to get some drill holes, and hopefully Ewan can fill us in on that. The gold and silver price appreciation, I think that's going to continue to be strong. And I think the silver portion of their resource is going to get more attention. It's around 100 million ounces, and this is not insignificant. You can see on the right, the strategy, the average cost brought us down to 62.9% or cents, which now is I think it's still at $1. I don't know what it's closed at today, but that's over a 50% return. And that the outlook remains, this is a long-term position for me. Finally, I was in Argentina to film this, Field Notes. It's my video series on YouTube. The episode's around 30 minutes. It'll be published next week. It's focused on Abra Silver, my biggest win in the resource sector. I suggest you check it out. If you have any questions, let me know in the hall. Thank you very much.